Capital gains on distribution of assets by companies in liquidation. Now, again, let's first understand pictorially as to what does this mean. So let's say, for example, there's a company. Okay, we saw this for a firm earlier. A company has various shareholders, right? This company goes into liquidation. What this means is that the company is basically coming to an end. Liquidation again is a court-driven process in which court appoints one person known as the liquidator, who is supposed to sell the assets, okay, realize the money, pay debts, and balance, if any, which is left, is paid to the shareholders. So the job of a liquidator is to see that, whether the company has any assets. If the company has assets, he will sell these assets, he will get the money, whatever is the payables to the outsiders, he is going to pay them in that order. There's a defined order. Let's say creditors are paid first, then the loans and liabilities and all those things. And the balance money which is there is going to be distributed amongst the shareholders. Now the interesting thing is, at times it is only not the money, balance money or assets. Okay? It's not only the money, but some assets may also be there which are transferred to the shareholders. Right? In this case, if a company transfers a capital asset to the shareholders, okay, it's a transfer, right? So there are two perspectives. One, the company transfers the asset, okay, and second is the shareholder gives up his share, okay, because his share are now going to be meaningless, and in exchange he may get either money or assets from the company, right? So we will see what will be the tax treatment in the hands of the company and what will be the tax treatment in the hands of the shareholder. Distribution of assets by a company to its shareholder on its liquidation shall not be regarded as transfer for the purpose of section 45. What this means is that when the company transfers these assets, from a company's perspective, this transaction is not a transfer. And I have explained to you that if it is not a transfer, that means what? There is no capital gain. Right? So there is no capital gain in the hands of the company. Now, one interesting thing which I want to tell you is that it is only when the company transfers the asset to the shareholder that there is no capital gain. If the liquidator sells the asset, okay, then there is a capital gain in the hands of the company. Capital gain, yes, okay, but if the company transfers it to the shareholder, then there is no capital gain, but there is a tax or a capital gain in the hands of the shareholder. So let's see that. Taxability in the hands of the shareholder. Shareholder shall be chargeable to income tax under the head capital gains based on sales consideration arrived at as under. So the shareholder is taxable, okay, and what is the sale consideration? The money, if you receive cash, so received, or the market value of the other assets on the date of distribution, right? So this on the date of distribution is important, right? So when you club the total money that you receive plus the market value of the assets that you receive, you arrive at the sale consideration. From this sale consideration, two things have to be reduced. One is the standard one, which is the cost of the assets or index cost of acquisition, as the case may be. The second is amount assessed as dividend within the meaning of subclause C of clause 22 of section 2. Now, how do you calculate this? You are going to see this in income from other sources, but just for the sake of completeness, whenever a company gives any asset or distributes any asset to the shareholder, this is deemed as a dividend. Okay, so let's say the company gives to the shareholder an asset worth rupees 500. This will be deemed as a dividend, but only to the extent that company has accumulated profit. So you will see the balance sheet of the company and see what is the accumulated profit. So if the accumulated profits are 300, then only 300 out of this 500 will be treated as dividend, right? So the asset distributed by the company to the extent of accumulated profits are treated as dividend. So if that be the case, so let's say for example, the money that, cash received by the shareholder is 500, fair market value of the asset is, let's say, 1000, asset. And this is applicable only for asset, Let's say the accumulated profits are 500, right? Now, how will you calculate? And the cost of acquisition or the index cost of acquisition is 300. Now, how will you calculate the value of this capital gain? Money or received, or the market value of the other assets. So money, cash is 500, asset is 1500. From these, I need to reduce two things. One, amount assessed as dividend within 222C. So I told you this, the amount treated as dividend is to the extent of accumulated profit, which is 500, and the asset distributed are 1000. So 500 will be treated as deemed dividend. So the value will be 1000. This 1000 minus cost of acquisition, which is 300, which gives you 700. This amount will be taxable under the head capital gains. This 500 will be taxable as income from other sources, right? So two things from a company's perspective: when you distribute asset on liquidation, no capital gain. From a shareholder's perspective, there is capital gain. How do you compute sale consideration? The money or the value of the asset received. From that we reduce deemed dividend and cost of acquisition.